Hi, everyone. I'm Kevin Kaplan, the Chief Operating Officer with Long Realty and also resident market analyst here tracking the Tucson and Arizona housing markets, and thought I would just spend a few minutes with you giving you a brief update on what's happening with housing right now through July and give you some context. So let's kind of jump into it. Let me share my screen here. All right. So let's dig into this. Now, I mentioned context. Context for me is very important because there's lots of things. There's national versus local. There's what's happening right now and how does that compare to what, when, is it good, bad? I'm hopefully going to not only share some market trends, but give you a little context that may be helpful. So I mentioned national versus local. We all know weather is very localized, especially if you're in Tucson or Arizona and it's this time summer and it's monsoon season. It can be storming on the east side and it could be sunny on the west side. That's just how Tucson works. That's how weather works. Real estate to me is very much the same. You could have one neighborhood very strong. You could have another one not so strong. You could have one state strong and another one not. So when you see national headlines or national real estate numbers, you have to put it into context because that may not be what's happening here, right? You don't look at a national average, what's the temperature per day, the national average, and dress that way. That just doesn't work because it doesn't impact you. It's the same thing with real estate. So just be aware of that. Also, to frame some of the conversations we're going to have, I thought we would just look briefly at mortgage rates. It's such a big driver related to buyer demand and where we are today and where we've come from. We won't spend a lot of time on this, but if you go back 10 years, rates were in the 4 to 5 range leading up pre-pandemic, and then we know what happened in the pandemic. All rates, Fed rates were lowered, which impacted the Treasury and the 30-year mortgage rates, and they came down. And it created a very strong seller's market and a very frothy kind of real estate environment. In 2022, inflation was starting to creep up, so Fed raised rates that impacted the Treasury and mortgages, and you can see where they've been. They've been in the 6 to almost 8 range since then. They're currently, as of this week, according to Freddie Mac, at a little over 6.5. So they've been trending down just a hair. But when you see the changes in the real estate market, a lot of it's been driven by this. Now, mortgage rates that were 2-3%, that is atypical. That's not normal, historically normal. That's probably, we'll see if it ever happens again in our lifetimes, but that's not the baseline. And that's why context is important, that that's not what we've been dealing with historically. Okay. Now, the other thing, I help bring some context as we look at first the demand side and then the supply side. I took a look at what a 5-year average is using the years 2015 to 2019. And why did I do that? Because those were the last normal growth years in Tucson before the pandemic hurt. We have to carve out 2020 to 2022 to use as a baseline because it's really not relevant because it's such an anomaly. And so I looked at those 5 years to see what was the average experience like in those years. And then I've compared that to last year, 2024, and then year-to-date 2025. So let's dig into it. This slide here is how many listings went under contract, meaning open escrow, there was an accepted purchase agreement on properties by month. So you can see that dotted black line, the 5-year average. It tells us what the 5-year average was, but it also gives us seasonality. And that's the other context. Sometimes you hear headlines about, well, sales are down in July versus June. Well, in our market, maybe that's normal seasonality, and that's not news. So that's something to be aware of as well. So in this chart, what this is telling us is that through May, we actually tracked this year very, very close to last year in terms of the number of buyers and sellers that were agreeing on a contract and properties going into escrow. The last 2 months, June and July, that orange line, you can see we're actually trending a little bit ahead of of last year. So it's above the blue line. And you can see that gap between the black dotted line and the orange line is smaller than it was earlier this year. So that's a good thing. But normally we see our peak in March, that black dotted line. And you can see throughout the year that that tends to seasonally go down throughout the year. So it's just something to be aware of. When we look at closed sales for residential, how does that look? Well, the black line, we typically see a ramp up in the spring, and our highest closing months are April through June, which makes sense because those typically trail when properties go under contract. Then it takes time for those transactions to actually close, and then it will go down throughout the year after that. Well, this year we're tracking really close to last year. We had a couple months we were a little above, a couple months below. We're not even a percentage below last year, so we're very much on par with last year. But you can see that the difference, the gap between the black line, the dotted line, and where we're at today, that there is a gap there, and a lot of that's due to mortgage rates being higher than they were during that other time period. 6.5 to 7 versus 4.5. So that's something to be aware of. So yes, demand has slowed down. On the supply side, so that was demand, that was buyers. Now we look at supply side. And if we look at active listings each month, how much was available, you can see the black dotted line. We start off the year, it tends to trend down, picks back up a little bit in the fall. The blue line was last year. So we've been dealing with, for many years here after the pandemic, an extreme shortage of inventory. You can see that last year is when we started to equalize that and get back to normal levels. Back late summer, early fall last year is when the number of listings kind of got back on track to what's normal, if you look at that 5-year average. And then this year, you can see we started the year pretty average. The inventory has gone up more than it was, but it's starting to trend down, which is a little bit of normal seasonality. So we do have more active inventory than we had last year, and we have more than the overall trend. But it is seeing some seasonal adjustment here the last few months. New listings. So how much of that extra inventory that's out there are new listings? Well, the black dotted line you can see is the 5-year trend line. Last year, the blue line, we were under the 5-year trend. But you can see this year, all the way through May, we were pretty close to what normal levels of new listings each month coming on the market are. So that's not bad. That's pretty normal, tracking the historical averages. June and July are actually under what's normal. So it's not like we have this big glut of new listings coming on. It's pretty normal, and the last 2 months have been tracking under normal average. Now, about 3 or 4 weeks ago, there was an article that came out from Realtor.com, mapped the 10 slowest housing markets in the US. Tucson was listed as number 4. Is that accurate or not? Well, if I went deeper into the article, the only metrics they looked at was days on market and how much it's increased year over year. And they just took the 10 markets with the highest % year over year increase. In my opinion, that's a very siloed kind of blinders way to look at the data. It's just one, days on market is just one factor, and that does not dictate whether a housing market is slow or not, or is just normal. So I'd like to dig into that just a little bit. So here's days on market in Tucson. The black dotted line is our 5-year average from 2015 to 2019. Blue is last year, orange is year to date. Interestingly enough, last year we were under that 5-year average till mid-year, and then it was kind of pretty close. This year, all the way through May, our days on market here in Tucson were pretty historically normal. I mean, having 50, 55 days on market, and that's how long it takes for a listing to go on market on average to go under contract. That's actually really normal. The last 2 months have ticked up a little bit, though July is a little bit better than June. So having a days on market above 50 does not mean you're one of the slowest housing markets in the country. It means that the market's adjusted and is more normal. And this is not abnormal. So again, context is important. The other thing that we look at in the housing market is something a calculation called months of inventory. And all this says is how long would it take at the current sales pace in the marketplace to sell out the inventory that's already out there, right? And the rule of thumb is kind of 4.5 to 6.5 ish. There's a little leeway there. Is what we consider a balanced market, meaning the level of supply is matched and balanced to the level of demand, and it's neither a buyer's market nor a seller's market. Okay. When you get that number really low, like we were during the pandemic, we didn't even have 1 month of inventory. We had weeks. That's a strong seller's market. Okay. If you get up to 7 or 8 months, that's a buyer's market. Okay. You can see where we're at. We typically start the year in January in a balanced market, and there's seasonality, and then we sell out the inventory, and then it kind of moderates. The blue line last year, we started off below what the normal is, and then we kind of adjusted to normal. This year, we actually started for the first 3 months with pretty much on average. It's ticked up a little bit in the last few months. But if you look at where that orange line is in July, we're at 3.8 months. That's shy of the lower end of a balanced market. So it feels more like a balanced market, and the 4.5 isn't a hard line, and it really depends on your neighborhood. But we're not in a buyer's market. We're not in a super slow market. We're in a balancing market. Okay. So again, context is really helpful to see and understand. How does all this demand, supply interact and in fact, home sale prices? Okay. So 2023 is the green line. You can see in the beginning of the year, we did come up, and then it really stabilized from there. The blue line is 2024. We saw some appreciation through mid-year, and then you can see it kind of flattened out. And year to date, it's very stable and very consistent and almost flat line. So that's not a bad thing, right? Historically, if you look way back in data, decades and decades of data, historically, home sales prices go up maybe 2 to 3% a year, not 10 or 15 like we saw during the pandemic. Again, we have to reset our context because that is not normal. So right now, we're in a very stable pricing environment. We have buyers and seller conditions kind of matched, a little more balanced, and that we would expect to see stable pricing. So that's where we're at today. The good news is for people that own homes that bought them X time ago is they built equity and they're holding on to that equity that they have. So what does this all mean? What do all these charts mean if you're a buyer or seller or just someone that owns a house? If you're a buyer, the current conditions compared to what it was a few years ago means you have more choice. You feel less pressure to just buy the first thing that comes on the market, or the FOMO piece of fear of missing out. There'll be no other houses for you to pick from. You have more choice. They're taking their time a little bit. That's why days on market is normalized more. And you can find a property that really works for your needs. You have more leverage in the past cycle, that really extreme sellers market. Buyers felt they had no leverage at all. They were waiving contingencies and things that we wouldn't advise to do, but that was the market. Now there's more room to have some back and forth with sellers and maybe ask for things. And this window of stable pricing, I believe that eventually mortgage rates will come down. We don't know exactly when that is. There's a lot of factors to that, but at some point in the future, if those come down, honestly, I think there's a lot of pent-up demand, and I think when rates do tend to try down, we're going to see more buyers enter the market, and that means probably more future appreciation. So there's an opportunity, even though rates are where they are, you have to look at pricing too, and you're setting yourself up for potentially future price appreciation. We just don't see a big housing crash coming, not with the conditions where they are right now. For sellers, there's more competition. So if you're still living in the 2021 world and think you're going to sell your house in 3 days and get over ask, that likely isn't going to be the case. More likely is you're going to have more competition. It may take a little longer to sell your house, which may mean that you need to have your property more market ready. The third bullet on here, price competitively. If you want to sell it, you have to price it to the market. Not what the market was 6 months ago or 12 months ago, but what it is right now. And you have to be open to, you have less leverage than if you sold 4 years ago. And there's probably going to be there's more even playing field between you and buyers in terms of leverage or negotiating. So that's something to be more open to. So, and if you're a homeowner, it means that you probably have built a lot of equity if you've been in your house for a bit and you're holding on to that, and that's a good thing. So lots of information here. Your first stop for any questions is your loan realty agent. They're very versed in the market and in your local area. So that's your first stop. But you can also go to loanrealty.com. We have our market reports on there. You can get from your agent, but you can also go online and get them. And then we're posting some analysis on the market in our blog on a regular basis. So feel free to do that. And we're here for any questions. So thank you all so much.